Good afternoon, ladies and gentlemen. Thank you for joining us and wherever you may be from. My name is Surbhi Kejriwal and I'm a partner in Khaitan's Corporate and M&A Group. I will be your moderator for the webinar today. On behalf of the firm, I would like to extend to each of you a very warm welcome. This is the fifth webinar in our M&A Master Series in 2023 and we look forward to your company throughout the rest of the series. We've received a great response to our webinar M&A Master Series so far, and we look forward to your continued patronage. The topic for our webinar today is structuring private business acquisitions. A little bit on the format. Those of you who've joined us for previous M&A webinar series would be familiar with the format. We've done this in the form of a Q&A with our expert panel, wherein I'll be posing certain questions to our expert panel. And we have about 15 to 20 minutes reserved for audience question and answers. Please utilize the facility in the portal to give us your questions. It's only with your active participation that we can make this webinar engaging. While we will try our best to address all questions, due to time constraints, if we are unable to address any of your questions, we'll respond to your questions offline. After the webinar, you will receive a link to the recording of the webinar, along with a summation of the key issues that we discussed. Just a little bit now on the structure and the topic for today's webinar. Today's webinar is structured as private business acquisitions. Now, acquisitions, as you all know, is a fairly wide topic. It encompasses within itself listed acquisitions. We have cross-border mergers. We have court-driven acquisitions. Now, each of these topics are wide, deserving a separate discussion, some of which we've already factored in and we will factor in our subsequent webinars. But for today's discussion, we've restricted the discussion to structured private business acquisitions. We'll be dealing with a whole host of issues in these few minutes relating to structured business acquisitions, which will encompass commercial, tax, of course, legal, and then finally dovetailing it with prevalent industry practices. And I expect this discussion to be very engaging, and I hope you will enjoy this as well. I will draw on the cumulative experience of our expert panel today and explore all of these various facets of private acquisitions. We're very fortunate to have with us a very robust panel with us. You know, we've tried to draw this from various practice areas and various aspects of deal makers, various kinds of deal makers. In the internal, from amongst the internal panel, we have with us Prasenjit Chakravarti and Nikhil Narayanan. Thank you so much, Prasenjit and Nikhil, for joining us and taking time out. Prasenjit and Nikhil have a wealth of experience between them and have advised on some very, very complex transactions. From our expert panel, we've really taken the Holy Trinity, a banker, a general counsel, and a valuer and an accountant. We are fortunate to have with us Rakesh Prusti. Rakesh is the Group General Counsel for OYO. Has a wealth of experience in sort of looking at acquisitions very, very closely, structuring acquisitions very closely, both the good and maybe the not so good parts as well. So we'll be looking to Rakesh to sort of give us a very sort of practical view of what his experiences have been as general counsel. We have with us Ajit Krishnan. Hey Ajit, Ajit is a partner in EY and will talk to us a lot about taxation and valuation and his perspectives on how to bring the deal together. And then of course, last but not the least, to use a cliche, the glue that sort of binds us all together, the investment banker. We have Prateek from Output Capital. Prateek will sort of tell us more about practical aspects on what his experiences have been in structuring private business acquisitions. Thank you, gentlemen, for joining us for this webinar. And without wasting any further time, those of you who've registered for this webinar would have already received the credentials of our expert panel. They need no further introduction. So without sort of going further, wasting further time, let me directly go into the questions now. Thank you, gentlemen, for taking the time out. My first question, Nikhil, is for you, if I may. What are the various structures that you've seen when we talk of structuring business acquisitions? It's a very wide topic, but if I were to sort of request you to narrow this down to maybe 2 or 3 key structures that you've seen prevalent, what would your take be on that?
Share acquisitions are in some ways the simplest. Just like any other part of the world, you acquire the shares of a company, lock, stock, and barrel, with all the liabilities that come with it. That's good and bad. It's good because, other than, change of control, type of consents and regulatory consents, depending on the sector, which you couldn't avoid anyway, it's relatively straightforward. You don't have to have any more evolved process in terms of transfer of employees or novation of any contracts or anything of that nature. But it does mean that obviously your diligence needs to be robust because you're inheriting everything, and that you do need to take care in negotiating your warranties and indemnities properly to exclude risk outside the perimeter of what the buyer wants to take. You then have slump sales, which are which is effectively the transfer of an undertaking as a going concern. So this means that the consideration is not apportioned between the assets, and there is no GST if you structure it properly, and there are some direct tax benefits depending on the holding of the assets. It doesn't matter as long as the undertaking is held for 36 months, then you get long-term treatment. You have to transfer the entire undertaking, so there's no possibility of excluding specific assets or liabilities. Having said that, it doesn't mean that every single asset has to transfer. The test is that the undertaking needs to stand on its own 2 feet. So inevitably you have situations where there are shared contracts or shared assets, and then there's a judgment to be made on whether the business can stand alone, and arrangements for fulfillment of contracts that don't go over, or replacement, etc. And then finally you have asset sales, which again, the difference between slump sales and asset sales is sometimes confusing for some of the international councils we deal with, who may use them more interchangeably. In the asset sale, obviously, there is a possibility of cherry picking assets and excluding liabilities. You don't get the GST treatment, but it can be quite useful in terms of excluding liabilities. So both slump sales and asset sales have different uses. Slump sales are very useful, for example, in post-global merger integration. So you have a global M&A deal, both buyer and seller have subs in India, and you can bring them together much more effectively through a slump sale rather than doing a court-approved merger scheme, which is going to be much more, lengthy. Asset sales are useful despite the absence of the GST benefits, because sometimes, you do a diligence and then you find that there are some liabilities which you may not want to inherit, and don't have that much confidence in the seller's ability to indemnify. So you can strip those out into a clean company, the assets that you want, and then acquire or subscribe for shares in that company. It doesn't work for all liabilities, like some statutory ones.
Of course.
But these are the 3 broad tools in our toolkit.
Thank you, Nikhil, for that succinct but very, very important sort of lead on what are the various ways in one can structure business acquisitions. I want to pick on one particular thing, Nick, that you mentioned, and maybe Rakesh, you could weigh in with the wealth of your experience. When we talk of currency for a transaction, and by currency I don't mean denomination, but stock versus cash. You're of course in a tech company, and you must have seen this often, and that's something that we've been seeing a lot. That acquirers now prefer to have their own stock as currency for the acquisition. What are your thoughts on that? What do you think? What has led to this development in the recent past, over the last 3 or 4 years, maybe post-COVID? And what are your thoughts on that?
Thank you, Surabhi, for inviting me to the forum. First of all, I think let me actually break it down into 2-3 parts. One, what is the need for the acquisition? Okay. The second, is what are the inherent risk and liability in the acquisition. And the third is what is the benefit of the acquisition. If I break it into three parts, is it an acquisition for acquiring high velocity supply growth, getting cost optimization, or getting more customer base, or getting better capacity utilization? All of this brings a different set of value into the business for which the acquisition is done. The seller, one way, is actually exiting basis value creation that has already been done, and the buyer is actually looking for more accentuated value creation in the future. And the reason I am actually highlighting this as the basis and genesis of this acquisition is also from the perspective that what is being targeted. Are you targeting human capital? Are you targeting the assets in the business? Are you targeting that a cohesiveness existing in the business is going to create more value? So I'll come to the cash versus equity one more step later, but understand the fact that this structuring that Nikhil has actually very rightly and very carefully elaborated for all of us is very dependent on not only about the purpose of the transaction, the vehicle that has to be used for the transaction, from the perspective of whether there is a liability issue, the timelines to do the acquisition, the regulatory approvals required for it, the tax consideration, or charge on the existing assets. I'll give a very classic example of a situation that I went to in one of the financing discussion, and the acquisition was having a kind of acquisition financing. So that means the expectation from the financier also to try and keep it in a closed, isolated vehicle rather than completely integrating into the business. That created two specific nuances. One nuance is that are you able to get the full value of the synergy from the business, versus at the same time are you able to retain the existing intrinsic value of the business, which is more important. And how do you navigate this complexity? That becomes one of the very, very critical aspects of a transaction structure. I'll go specific to your the cash versus equity.
Right.
I think if you're looking at high velocity supply growth and you have an existing asset which is actually providing you the supply and you don't need anything else, probably the person is actually more exiting, maybe a cash transaction with minimal amount of deferred cash, probably another way to look at a transaction. There are transactions where we do in tech sector a lot of acqui-hire. So somebody has a search engine optimization business, develop some IP on that. You want to more pick up people rather than there is a big business and customers and so on. So you actually you're trying to acquire human capital through that entity. So it could be minimal cash and much more equity or stocks swap actually at that moment. If you're talking about entering into a new market, a new business, you need to have the same set of people who are running the business. They must be a part of the ongoing business in future with you. So there is a huge amount of cultural alignment that is required, in addition to cash, in addition to stock, and more importantly, the equity that they are going to subscribe into. That means they have to buy into your own strategy to be a part of the whole overall organization and the culture. So there is no thumb rule for this. So depending on the practical nuance of the business and regulatory structure, it could be a cash plus stocks, it could be a cash plus deferred comp, it could be a cash plus earnout, because you would expect them to actually run the business, develop the business, and get paid for the value they created in future along with you, or probably this ESOP that you have. It's a combination of the things. In a unique transaction, I'll give a 30 more seconds of example where dwelling on what Nikhil just pointed out, a transaction that needs to be optimized from a tax standpoint, from a structuring standpoint, because it is an acquisition financing. That means you have to keep the entity isolated still to get the IP there, and importantly also optimize from the tax standpoint. It required a kind of slump sale through a demerger, and I'm just using a very typical way to look at the slump sale. I'm saying that because you're actually selling some of the part of the business through a demerger into another entity through a demerger process. Then it is an LP GP structure in an LLP company in a European region. That means you actually get the GPs out. That means the LP business has to be folded back to an entity which is your main entity that you expect that to acquire the business, and do a reverse merger with that. So There are multiple level of permutation combination that can go in, but it all depends on which dimension we are actually tapping into.
Absolutely. Thank you so much, Rakesh, for that nuanced perspective. Prateek, I want you to weigh in on this. From your perspective, as somebody who's perhaps the first point of contact of a promoter when he's looking to stitch together a deal, do you think stock is a better incentive for the promoter, or do you think cash is still cash? Ajit, Rakesh also touched upon tax, and I think it'll be you can't overstate the importance of tax in M&A deals, but particularly on the stock versus cash bit. Do you think, purely from capital gains tax perspective, from a seller's and a promoter's perspective, because our audience, of course, is wide, and we have a lot of promoters as well who've sort of tuned in, but do you think it sort of makes any impact from a valuation and from a capital gains tax perspective? Is it easier to implement? Do you think it becomes complicated, or is cash still cash?
No. So thanks, Survi. I think let's address this in two parts. One is, if you have a cash value, then there's certainty of the value of the transaction. So everybody knows what's the base number on which you have to pay the tax. But more importantly, the tax authorities don't accept stock as a currency. So if you do an all stock deal and the seller gets a bunch of stock, he still needs to cough up cash to pay the tax if it's a stock, right? So if you do an exchange, you're still liable to tax. Then you have to scurry around. So unless and until you're cash rich, and this, in which case the moot question is, why are you even selling the business? So there are a whole host of issues that you get involved. So generally, in my experience, an all stock deal generally gets stuck on the point, and for all the right reasons Rakesh mentioned. If there is a strategic intent, if there's a buy into the strategy going forward. So commercially, if parties have agreed, then it becomes much more important for an all stock deal to be structured in a tax neutral manner.
Right.
Because if you do it on a non-tax neutral, where you're saying, here's my business and give me stock, or here's my company and give me stock in exchange, like a swap transaction.
Right.
The seller needs to cough up cash, and then you're getting into areas like, how do I arrange loans? Can I borrow against this stock? Can you lend against this stock? Then you're creating a whole new set of relationships and related party transactions. So that is one of the complexity. The second complexity in a all stock deal is, it's basically an exchange. If you think about it, it's a barter, right? You're selling something and getting something in exchange. And any barter transaction, you basically try and value it at the higher of either, which means you're now adding the complexity of valuing two different instruments. So valuing what you're going to get basis its own combined DCF value, future value, future potential. So, the level of complexity increases, but, I think it's still possible to structure some of those deals. So like Rakesh mentioned, let me give you a little bit of an Indian context, and, Nikhil can probably, or Prasanjit, of course, and we all have worked on such deals. We will classically call this a merger, where you have an entity combining into another and you get stock in return. That's a good way of doing it on a tax neutral basis. The other is, you're not looking at entirely the entity, but maybe a business division. So can you really call it a demerger into the acquirer and then get stock in return? And sometimes if you still want to ring fence, you could demerge this into a subsidiary of the acquirer and get stock of the acquirer, so that the acquirer has full control on the business. You're not having disproportionate shareholding at the asset level, but you're also participating in the overall picture. So there are ways to structure this, and clearly, but I think the more important question that is foremost from a tax authority standpoint is, and if you talk to any tax advisor in the Indian context, there's a catch-all phrase, GAR, generally the anti-avoidance rules, and so for everything you can invoke GAR, and for everything you can also say that GAR does not apply. But that is where I think it becomes imminent to figure out what's the real intent and objective and the business rationale for the deal. So if this is a stock deal, which means you're participating in the future of the combined, then clearly you should look at structures and not get too caught up with the GAR provisions.
Absolutely, Ajit. Thank you for that. And Prasanjit, I would like you to weigh in here. I mean, we know as M&A lawyers that having stock as currencies is very, very prevalent in the US venture capital ecosystem. And with US money that was coming in and still continues to come in, it was a very easy and a very palatable transactional structure on term sheets. But as lawyers, we know there are this whole structure is fraught with challenges from an exchange control perspective. Do you want to just tell our audience maybe a little bit on how one can navigate this, and if it's really worth the hassle of going to the regulator? Are we getting approvals? Very broadly, what's happening in your view on this whole stock versus cash conundrum?
Yeah, I think it's definitely worth the hassle. I think to kind of approach a regulator if the deal dynamics are such that this is what it takes to make a deal happen. For instance, the buyer doesn't have adequate cash to really discharge the consideration upfront, and a share swap arrangement really kind of helps you bridge the gap, so to speak. I think definitely is worth a shot, despite it not being as seamless as an all-cash transaction, provided you keep these checks and balance, which Ajit mentioned and touched upon. Definitely, I think it's not something to really shun away just because it's complex, it needs approval. Definitely should be considered from transaction to transaction, and it is being considered, I can tell you that, where there are practical issues, and if the buyer has its own value and synergically the seller also can get value and offshore presence, why not? Definitely.
Right. Talking of value creation, I think Prasenjit, staying with you, the corollary to value creation is, of course, value preservation. And when one talks of value preservation, the next sort of topic that easily flows post is safeguarding a buyer from successor liabilities. There is, of course, a huge tax angle to it, and Ajit, maybe we'll come to you later for that. But Prasenjit, from your perspective, how does, from a buyer's perspective rather, how does a buyer safeguard itself from successor liabilities when you talk of business acquisitions in particular?
Yeah, I think that's a very important question, Survi, because I think first thing first is there are a few misconceptions which I will try and dispel through this brief response. I think firstly, if there is a massive liability sitting in a company and which is discovered during due diligence, naturally the first thought is there's to a cherry-picked asset deal, because that's the conventional wisdom that you don't acquire the entity because then you will inherit the liability. So let's do a hive off of the business or a cherry-picked assets and then do the transaction. That's point number one. Yeah. Second point is that even between asset sale and slump sale, because slump sale is a transfer of business on a going concern basis, it's very difficult to extricate and leave behind any liabilities which are attached to the core business undertaking which is sought to be transferred. So then that leaves you with asset transfer. That's the best bet as far as leaving behind any successor liability concerns are there. But is it a panacea for all ailments in terms of successor liability? The answer is not, because no matter what drop contractually, even in the asset sale, you can't wash your hands off as a buyer from statutory liability. So for instance, if there are massive tax dues, if there are past employment dues, PF dues, a seller cannot hide behind the contract, say, look, it's not my headache, buyer is the owner. Buyer turns around and says, it's a past liability, I am not accountable. I'm sorry, that will not work. There are explicit provisions under PF laws, tax laws, which spell out that despite a transfer of undertaking, the buyer will continue to be on the hook. So the question is then, if in asset sale also for statutory dues, a buyer is accountable, what should a buyer do? The buyer should, besides having contractual protections like warranties, etc., it should do firstly a thorough due diligence, because it's only when it knows what liabilities are there, it can then ask for specific indemnities from the seller. That for these tax liabilities, these employment dues, if you cannot settle them before closing, for whatever reason, let's say the seller doesn't agree with the tax authorities, it's in dispute, so it will not like to pay, but the buyer wants a specific indemnity which is not capped and is in actuals of loss suffered. So very important that you have a diligence done, identify the issues, and then have specific indemnities. If the liability is too imminent and too big, have also holdbacks, those kind of arrangements in place, so that you're not dependent on the indemnity protection. As we all know, indemnity is as good as the paying ability of the seller.
Absolutely.
So therefore, if the liability is imminent, I would strongly recommend earn-out or holdback or a deferment of consideration. But it's important to understand two things as a takeaway. If there are past liabilities, then yes, successor liabilities is an issue. Asset deal is the best option. Still, that does not mitigate everything in terms of statutory past liabilities, and therefore have a diligence backed with warranties and indemnities and structural mitigation steps to insulate yourself as much as you can.
Absolutely, absolutely, Prasenjit. Thank you so much for that. I think Prasenjit touched upon, and he mentioned that an indemnity is as good as the ability of the indemnifying party, and that sort of he's raised an important question, which is on counterparty risk, effectively. So from a banker's perspective, when you are talking of when you're at the term sheet stage, when you're talking to a potential seller or a promoter, is it something that you want to raise upfront with them that the buyer will be looking for certain risk mitigation mechanisms from a counterparty risk perspective, or is it something that you would like to leave for later?
I think, Surabhi, what definitely happens is once we start the preliminary work, there are always 2 or 3 major topics which we initially flag to the seller that it's likely to become a specific indemnity items, right, or an excluded liability type of items. That work is often done. However, as Prasenjit said, this indemnity, the fact that it's the ability of the seller. On top of that, let me tell you, in many transactions, both buyers and sellers, in friendly transactions especially, both buyers and sellers have this view that we don't want to open this agreement once we have signed it. Sure. And we have such good terms that we are not going to litigate. So find us a solution where at the stage of agreement itself, we know what we are buying in, what we are not buying in, and it's as clear as possible. Very recently, we did a transaction in which both buyers and sellers are very friendly. That was a very good transaction. Both of them said that I will never go after this guy. So please let us factor in everything commercially upfront. And on top of that, all the liabilities are not segregable. There are indirect tax liability, as Prasenjit or Ajit will elaborate. Indirect tax liabilities cannot be segregated from the asset itself. So they will always travel. So one has to look at a holdback or a upfront adjustment mechanism. Those are the two potential solutions which are possible.
Absolutely. Thank you so much, Prateek. Nikhil and Rakesh, I want the two of you to just step in and talk a little bit about, we always struggle as lawyers and deal makers in convincing the parties that there is deal certainty. Now, I'm using the term, of course, very loosely, but when we get down to the nitty-gritty of stitching together the contractual documents, it becomes a big point. Rakesh, do you want to go first in terms of, you've been on both sides, right? You've been on the buy side, and of course, you've been on the sell side. How do you tackle with something like deal certainty? If you're a seller or if you're a buyer, what are the levers that you will look for whilst you're at the drawing board stage and the structuring stage to ensure that there is deal certainty?
Sure. So let me say this in twofold. I'll go back to one step back, what Prasen mentioned about the indemnity part, and I also added to here. 2 things actually I would like to say, that to have a deal certainty and have a buyer protection, what's most important is the very basics of a deal, which I would say that don't go for the woods to miss the forest. Okay, which means how did you segregate your due diligence activity to go deep into what is important for you and what is livable. And I can give you one classic example. I actually personally did a deal way back in like 2015. So I actually did the deal basis a vendor due diligence, and I had only 3 questions. And probably, let me also put it this way, that was also the expectation of the seller. So we actually worked around that to say that in these 3 questions, how do we ensure that we build the deal? And because it is the same sector, we have the operational expertise. I did not worry about too much in the operational side, but I just focused on the structure. And to stitch further to what you're asking as a question, how do you ensure that you focus on the transaction document not having a material adverse effect clause. So there are many times people do negotiate about MAE event, and that actually make it like a kind of quasi uncertain deal for people. Stitching further to Prasan's point, how do we get a buyer and seller both secured? And if I can just say that a warranty and indemnity are still on paper, depends on which jurisdiction you are trying to enforce it. Can you bring an insurer to solve this problem? Globally, and at least internationally, I've seen that there are about 60, maybe 70+% in large transactions are actually going through a W&I insurance. In India, probably it is like it's still about, it's in the stage of evolution, 20% or so, maybe large deals, yes. And how do you solve that through insurance? Because many times it requires the value creation through outgoing seller, that they will still be a part of, it's a kind of combination situation, they will be a part of the business. And you don't want to fight with them. Pratik mentioned that. So you want to actually have them in the management team. So you don't want to make a claim against your own partner. So you think that a W&I insurance through a due diligence report that we have created will actually help solve this problem, right? It is solving for both. Third thing, I would just add on to specific point on the diligence on the regulatory approval process. I think it is very, very important. For example, it requires an RBI approval for a remittance to be made for an investment. Many times you think that that is only going to be one aspect of the approval, but then there are deep dive into it. If there is a company which has certain past legacy issue that requires a further escalation by RBI and so on. So you have to look at that, those regulatory approval process very, very minutely to ensure you factor those things in the document and ensure that the buyer is taking adequate steps to socialize on getting the approval quicker rather than later to let the deal fall through. And I don't think that it is the buyer's interest of having the deal. It is also, the seller's interest to have the deal. It is also as much as the buyer's deal, right? Because there are a lot of things that you may have done by as a listed entity. You may have actually communicated to the stock exchanges that we are looking at a property and their market has behaved accordingly, and then they're expecting that you are going to close the deal and so on. If you don't do, there is a potential downside. So I think deal certainty through clean, exit route, WIN insurance, a proper deep dive of the SPA as well as the due diligence document for the insurance to pick up a good deal for you, getting the residual risk which is covered by the seller. For example, if the insurer is saying that I'm going to cover 30% of the deal and that's the liability cap or indemnity cap you have agreed, and there are still deductible in that insurance policy, you can still negotiate with the seller that this is the minimal expectation that I have from you to secure this deal.
Of course.
So
of course.
I would say a combination of all of this, I think both it will add speed to the deal and certainty to the deal.
Yeah, absolutely. Nick, do you want to come in and tell us from a lawyer's perspective and purely from a documentation perspective, how do we tackle deal certainty?
When we talk about deal certainty, there are three ways of achieving this, right? There is the process, there are the outs, and then there is funding. So let's take each of these in turn. As far as the process is concerned, obviously as a seller, you want to keep the buyers on a tight leash, right? And you want to generate competitive tension in the process. Now, that's obviously easiest achieved through an auction process rather than a bilateral deal, which naturally always favors the buyer. But even in a bilateral deal, it may not be possible to run an auction, but even in a bilateral deal, if you're looking for certainty as a seller, you need to keep the buyer honest. You need to be very firm about exclusivity periods and the consequences of going beyond that. Set in place timelines and expectations very early. So that's one thing that will help in certainty. The second is in minimizing outs, and this is classically where lawyers get involved. Most transactions will have conditions which, if they're not satisfied, will allow the buyer to walk away from the deal. Now, as a seller, you want to keep that as tight as possible. And I have to say, in this regard, Indian market practice is probably much more buyer-friendly, even now, in comparison to various other international markets, at least until about maybe 12, 18 months ago, where there's just been a wall of cash, and where, in many cases, the sellers are able to dictate terms and say no conditionality other than mandatory regulatory conditionality, not even regulatory conditionality. Whereas we obviously have even in most deals, will usually have MAE provisions, will have no injunctions, etc., etc. So there'll be a bunch of outs, but obviously, as a seller, you want to try to negotiate that as tightly as possible. There's usually often some discussion, at least with properly advised buyers, on the scope of any regulatory consents. Is it a hell or high water standard, or does it come the ability to walk away if the regulator imposes certain adverse regulatory conditions? That's something that a seller will need to have on its horizon to negotiate. But obviously, minimizing those, and in the Indian context, you may not be able to avoid an MAE, but at least negotiating that properly. These are some of the things that you can do to tighten the process. And as far as funding is concerned, much easier in a public deal where the takeover regulations has provisions requiring certainty of funding, which is obviously not there in the private context. But obviously, sellers will ask for warranties on certainty of funding. And generally, as a commercial matter, will want to satisfy themselves pretty early in the process as to how the buyer is going to pay the consideration, and needs to get itself there that the funds are actually in place. Otherwise, it's a wasted endeavor, and they should draw a line in the sand right away.
Understood, Nick. Thank you so much. Prateek and Ajit, I want to ask a very pointed question to the two of you. Acquisition financing. I mean, of course, legally we know the challenges that one faces in financing acquisitions through the target's balance sheet in India. But purely from a tax perspective, Ajit and Prateek, from a deal-making perspective, how critical, in your experience, have you seen this issue to be? I mean, let's say if we were to take the last 3 or 4 years as a reference point, even with acquirers who are otherwise cash rich, it's always more efficient to use if you're able to use the target's balance sheet. Ajit, why don't you go first and tell us from a structuring, tax structuring, and overall structuring perspective, is this still as challenging, and what role does it play in stitching a deal together?
Yeah, so it is. It's not the easiest to pull the cash or leverage the asset of the target. The whole construct of a leveraged buyout, as we understand colloquially globally, in the Indian context, is still very is that essentially negative. As in, the regulatory framework is not really designed to enable it, and therefore you have to go through certain hooplas to achieve it, and that's really why the structuring. And I'm sure Prateek will talk about why it's value accretive, because at the end of the day, it just makes a lot of sense purely from an equity IRR perspective. If you leverage the acquisition, obviously your equity IRR improves, which means you're able to give more value. But I'll leave that for Prateek to address. From a tax perspective, if you look at an acquisition, and if the target is already asset heavy, which means it does not have enough leverage on the balance sheet, it means it has the potential to gain more leverage, which means raise more debt. The second is it already is sitting on cash, which means it's got a bunch of cash and treasury sitting out there and with no end use purpose. There is no capital expansion program that you're looking to design. So then does a buyer really pay value for that? So at least in the Indian context, when you're looking at it, even if you pay value for it, the fact is you will land up discussing and negotiating the discounting of that cash for the cost of actually upstreaming that cash. And that becomes very difficult because there are only 2 or 3 ways in which you can upstream cash: dividend, payouts, or buyback. And I'm assuming you have reserves. There are a whole bunch of assumptions that you get involved in. So classically, what we've done is we've tried to see a structure where it can be a win-win, which means you set up an SPV fund with the proposed likelihood debt equity, so that you effectively achieve the same desired result. Now it still means it's going through a step process. It's not something that's straightforward, upfront. But there will be an alignment of interest because there is a value accretion. But tax-wise, it's a huge cost involved. So, and also paying a premium for cash is highly challenging, especially because of the costs associated with withdrawing that cash.
Still, in the private domain, there are flexibilities, or there are always degrees of freedom are higher. First of all, you can while the seller may prefer, and in a straightaway slump sale, from acquirer financing perspective, slump sale is typically the easiest and the most preferred route for the buyer. You get to write up the asset. You have the full financing options because Indian banks can finance or which Indian banks can't finance on the share acquisition side. So slump sale is typically from buyer perspective is the smoothest or easiest way to acquire businesses. Typically, that does not work for sellers because there are two layers of, first of all, there is capital gain when you sell the business, then extracting that business has certain challenges. But overall, increasingly, as Ajit rightly said, there is a high amount of value of leverage because it does add to the overall equity IRR for the buyer. What if it has to be a share acquisition in unlisted domain, it still works reasonably okay with certain disadvantage of holding. There are certain restrictions on how much interest deduction you can take in the interim phase when the borrowing is at the holdco level. The kind of buyers that you will get, kind of lenders that you will get at the holdco level will be a little bit of structured finance type of players because they are taking a risk of while in the unlisted domain the risk of shareholder approval is not there, but still they are taking a time lag in an NCLT risk in terms of the merger getting completed. But I think overall corporate India has gone to that route where some mid-level solution has been compromise has been found. Of course, who gets the benefit of this leverage depends on the negotiation power, whether buyer keep all of it or it gets passed on to it. It's completely dependent on the process station.
Right, if I may just add to that, Surbhi, I think that's a very fair point. And what I find interesting is, there is this whole NCLT process, but you also have the fast track route, right, of the registrar of companies. So technically, people are kind of gaining comfort saying, okay, if it means I have to do a stepped transaction, it means first step is set up the company, buy shares, and then look at this immediate fast track merger with effect from the same date as the appointed date being the date of the acquisition of shares. Now, tax wise, we can find reasons to say why the step plan why was it a step plan in the first place, right? And then plan it and plan the whole purpose and intent. But then the question always comes back: is this fast track process really as fast track as it's supposed to be in the context of NCLT? And I think that's where it kind of is somewhere there is comfort, but still, a lot of this is untested. But I'm sure Prasenjit and Nikhil will have a better view on this.
Surbhi, I'll just add a quick practical bit here, very, very quick. So I think when we are doing acquisition financing, we have to be really careful about one specific fact that many times we as corporate, when we are doing an acquisition transaction, we put a lot of value on the synergy and value creation because of the combination of the unit. But at the same time, when we are looking at a target, there will be lots of covenants that will come in with the acquisition financing. I think at times, because they are staged slightly differently during the negotiation, I think we miss the fact that, or probably people miss the fact that reconciliation has to be done, that the covenant is actually not blocking your synergic benefit, because the approval process, the lender's consent, the third party consents actually come as a bottleneck for some of the synergies. So this process needs to be really stitched well to get the optimum benefit out of this.
Absolutely, Rakesh. Thank you. And you've actually given me the cue for my next question, which I have been itching to ask Prasenjit. Prasenjit, when we talk of integration, when we talk of synergies, when we talk particularly of asset transfers and slump sales, one thing that we always struggle with as councils is the chicken and egg situation. We can't sort of hand over a business on a going concern basis with the approvals from day zero. There are obviously some gaps. Some are practical, some are legal. In your experience, have you ever seen a deal sort of get stuck because of this? And if yes, what were the levers that you used to push the deal across the line, given these challenges when it comes to slump sales and transferring the business on a so-called going concern basis from a practical perspective?
Yeah, thanks, Surbhi. I think that's an incredibly important question, and I think inevitably this will be confronted by every party who is doing a BT on all deals, because as you very rightly put it in the question, you cannot have all licenses transferred on day one. So again, a myth I will dispel today is people often get confused that just because not all license or assets are transferred, can we close a business still? Of course you can. It's a contractual arrangement between a seller and buyer, and we can agree, let's say, next month to be closing date. Doesn't matter if half of the license are not transferred, deeds are not registered, that can take its own course. That's point number one. Point number two, when it comes to license, now I will give an example of a deal without naming. Our clients were acquiring a restaurant business, which amongst other things was also serving alcohol, for which you obviously need a license to serve alcohol. You can't just show up and start serving alcohol, right? Now, obviously, the seller will never transfer it prior to closing. It will not like to terminate his business, disrupt his business. So it will first like to get cash in its money or stock in its pocket, then only transfer the trading license. So therefore, on the closing date, what happened was that everything else was transferred, but this trading license could not be transferred. And then the buyer and seller had an arrangement that, look, the buyer will have its employees, etc., running the restaurant in the name of the seller's license. So the business continues to operate as it was without any disruption, but the seller was duty bound to give benefit of the license to the buyer. So that's point number one. Now, all this was documented in a transitional support service agreement, which basically recorded this fact that the seller continues to give the benefit of the license to the buyer, and therefore the deal closes. The buyer continues with the business from day one after closing. The seller gets some money to help out the buyer. Therefore, you must have a robust further assurance clause when it comes to this kind of a transitionary phase where the seller continues to help out the buyer. The buyer basically is in the process of perfecting some of the title to assets or licenses, and therefore it's a win-win for both parties. And this is, as I mentioned, invariably you will confront this situation. So you must be mindful of of course, this varies from sector to sector, the business in which you operate. The more complex, like a pharma sector, which has tons of licenses, it becomes more intricate. Alcohol is another sector which is very intricate. Therefore, you have to have specific treatment. But substantially, you must have seller's cooperation. If you think a hell of a lot needs to be done by the seller, please park some of the money in escrow. As a buyer, don't part away with all the purchase price, because then seller has no incentive to cooperate as much. So I think with that, you can tackle this situation and really come to I think a very reasonable solution.
Right. Thank you, Prasenjit.
If I may just jump into Prasenjit's point, I think, this is also a very tentative issue in terms of classification of a business transfer as a business transfer, right? Because Prasenjit, right? The alcohol example, that's fine. It's part of the business. It's not that the business is falling apart because there is no liquor license. It's just the operation. But if the business is hinging on the ability to have that license to run that business, and that's not been transferred, then the question is, did you really do a business transfer, or have you just bought a bunch of assets and liabilities? So that whole purpose and objective of saying, from a tax perspective, at least, there is enough jurisprudence to say, so long as it's a going concern, it's fine. Licenses, transitional support, all of that can come in. But you can't build a transitional support agreement for a preconceived or a precondition, a license or an approval or a name or anything else, which is like a requisite to run the business. So if it's a license because you have some approval which allows you to do that business, will not mean that then there is a business transfer. So that bit has to be addressed as well.
And also, Ajit, just to implement that, I think it's critical that when you have a transition services, it should not be for perpetuity, like 10 years. That will, I mean, you will be in hot water before tribunals and tax authority. So it has to be a stopgap arrangement so that you can always justify this is actually lock, stock, barrel, slump sale transaction. Absolutely agree with
that. Prasenjit, not only from tribunal perspective, on practical perspective, once some seller has exited a business, right? Trust me, the entire business management has gone to the buyer for transition support. And typically what happens is the seller, even whoever was the retained employee, has been redeployed for some other business purposes. That actually seller cannot support for too long. So typically we have practically seen beyond 3 months, for 3 to 4 months, transition support does not really work. So that is something that one has to keep in mind.
Right. Absolutely. Yes.
And I just want to dial back a little bit, Subhi, just take 30 seconds of your time. Sorry, I know there's a lot that we're trying to cover in this time. But, I think in the beginning, Nikhil mentioned about the GST impact on an asset purchase. I know it's a negative cash outflow on day zero. But, if your output product is there, he's liable to GST and, you have throughput of sales, then one really needs to do the maths and say, if I really want to just buy assets, why not just pay the GST and move on? I can get input credit, right? Or if I'm doing export, can I get a refund of that? It may take its own sweet time, but I'm better off locking up that little 18% cash. So that's a bit of a trade-off. It's not something that you summarily say, therefore don't do asset sale. I think that's the point I think we're all trying to make, but the GST is not necessarily in all cases a dampener. Sometimes it's actually a benevolent thing, because it might help you insulate yourself from past GST liabilities as well.
And you also get to cherry pick your liabilities in that case. You don't have to take all the liabilities that get attached.
Yeah.
So that's really a big one.
But having said that, I think Prateek alluded to the fact that indirect taxes still go with assets. They go with the business. They don't stick to the entity. Income tax liabilities always stick to the entity. So that's a fine line of distinction that one needs to follow.
Gentlemen, we're running out of time. We have 3 minutes for this panel before we take the audience Q&A. So I'm going to hold each of you to one 2-word answers for my next questions. Please humor me. Nick, starting with you. While structuring business acquisitions, what are your top two picks when you get a term sheet on your table? Let's say either buy side or sell side you can pick, but your top 2 picks, and I'm going to hold each of our panelists to that before we dive into the audience questions. We have some very interesting questions that we've already got, but top 2 picks, Nick, for you.
Number 1, liability management. What's the desired objective? And number 2, what are we looking at in terms of capital structuring and incentives? Because obviously it's easier in certain structures than others.
So liability management and capital structuring. Prateek, what are your 2 top, aside from deal certainty, what would, as a banker, what would be your top 2 picks?
Valuation, and if there are any gaps, any bridges that need to be followed, which we see a lot in unlisted situations. And second, you said apart from deal certainty, but our top pick is always certainty, making sure, because these are typically once in a lifetime decisions for either seller or buyer. So they want to make sure if they've taken that step, they see to the end of it.
Absolutely, absolutely. Ajit, your top 2 picks.
So for me, it's predominantly cash flow. I think taxes, at the end of the day, it's a cost of gains. So that's fine. Everybody's willing to pay tax, but cash flow is a key issue. Absolutely. And I think the second, to me, for any acquisition from a buyer's perspective, more so is what's the strategy? What's the purpose of this acquisition? Because without that, trying to figure out and jumping straight into structures is pointless. You're buying intellectual property, then we need to know, can I get depreciation on it? Are you buying an asset which you can amortize? Then why not consider? So there are a lot of other considerations. I think business synergy and objective, spending the 1 day to understand business synergy in intent and objective is very, very crucial. Or it could very well be a strategy to just buy to flip. So that's also fine.
Right. Prasenjit, your top 2 picks.
I am put in a slight disadvantage because my other panelists have already covered most of them. But I think I feel pity for Rakesh because he's going to speak after me. But I think the key point is the objective. I think the objective drives the structure. Once the objective is crystal clear, whether it's integration and all that, then you look at the deal dynamics in the sense how much the stamp duty will cost, how much timelines you have. For example, you may have a great demerger scheme, great tax benefit. Do you have 9 months? You may not have 9 months. So therefore, whether it's the liability, the stamp duty, the tax in one bucket, objective another bucket. Those would be the 2 strands I will stand on.
Rakesh, I'll tweak the question for you because I know you're at a disadvantage since I'm coming to you towards the end. But as general counsel, let's say, and we all know that we want to do deals, right? Because if the management gives us a term sheet, it's obviously the intention is to do the deal. But as general counsel, if you're a buy side, if your company is buying something, what would be the one red flag for which you will actually go to your shareholders and go to your board and say that, guys, look, I don't get a good feeling about this, and from my side, we need to be careful about this? What is that, maybe that one thing that sort of raises your antennas a bit?
I think I will still respond to the previous one being the last one. So I'll take one more point on that and I'll plug this one and this one. So for me, when you get a deal approval, I would say that the 100 days plan post the deal must be stitched together and gotten the approval along with the deal. If you don't have a 100 days integration plan, don't do the deal. That's what I tell my board personally. Second, quite a few times we ignore the value of the human capital, which is as good as or more than that of the property, plant, machinery, research, development, and so on. So I would rather say that the employee comes first, who are serving both sides, the supply side, the customer side, the vendor side. So don't forget them. So if there is no proper plan in terms of identifying key leadership, in terms of retention strategy, in terms of strategic communication with the employee on the cultural and behavioral change required to get aligned with the new organizational initiative, and most importantly, the benchmarking of their benefits, compensation in the future is not done, probably that's going to be one of the, I would say for me, it's a deal breaker kind of scenario. So I will put more emphasis on that. And the third point, today cash is king. Every organization is actually just talking about PAT and free cash flow, right? It is no more just EBITDA. So I would always structure a deal with a combination of cash and stock, or probably potential deferred or earn-out compensation basis what value that has been created over a few years, not for sustainability, but for growth alongside. And the fourth, to your question on what is that risk? If we are not able to identify those people who are going to be the one who will get integrated into the business and deliver the business growth with the behavioral or cultural change, that's the big red flag.
Culture.
Rakesh, on a lighter note, I was hoping you will say hire trusted professional advisors.
That is always,
I think one important point, Surabhi, on what Rakesh said, and what we
very important.
Right.
Sorry, Surabhi, last point from my side. What Rakesh said is very important on this people aspect. One is post acquisition, correct? How the integration is going to happen, have a big clarity. What we have witnessed, even while the transaction is going on, especially when there is a seller and who's selling a company, we have come across very different set of sellers. There are sellers who have this incentive plan linked to, because it's the management who's going to deliver the transaction and the value is dependent on that. So whether before you kicked off your M&A, have you thought about how is this management incentivized to deliver the best outcome for me? This is a very important aspect. This is something where Indian corporates are just, they are learning, they're on the learning path. A few of them have gotten there, but typically we have seen, especially with MNC sellers, they are very clear and they have put together a specific path. Their roles are very clear, who is going to run what, because that management is the one who is going to deliver the value, and they need to be aligned with the seller.
Thank you so much.
Structuring that management incentive plan is like one more webcast. You need full 1 hour.
Absolutely. I think integration and maybe tax are two. Maybe Prasanjit, you can pick those up as topics for our subsequent webinars. We will now, with the permission of the panel, go into our audience Q&As. We have about just about over 10 minutes left for addressing some audience Q&As. Ajit, actually, the first question seems to be something that falls squarely in your domain. It's actually, even I've been sort of itching to ask this. Very recently, these changes to taxation on goodwill have been introduced. And sectors such as consumer and pharma, which are very, very brand centric, have been deeply impacted. M&A activity has had an impact in these two sectors on the heels of this change. Could you sort of break this down a little bit for our audience as to what this change is in layman's terms for those of us who are not tax professionals, and B, what sort of an impact have you seen on M&A activity pursuant to this change?
Sure. So, this actually the change is more clarificatory because there were certain rulings which we were relying on earlier. So depreciation or amortization, right? You have on fixed assets and you have on intangibles. So tangible assets as well as intangible assets. The law was pretty clear from the start, saying that if it is an intangible asset which is of a commercial nature, you will be entitled to a tax depreciation against any acquisition price based.
Right.
But not so much for a self-generated asset. You can't just revalue a self-created intangible asset and say, I want to claim depreciation. Right? But if you acquired an intangible asset, being a commercial right in nature, which subsumes within itself licenses, permits, brands, patents, copyrights, a lot of other things, which can be easily identifiable. Now, what happens is when I'm buying a business, for example, and I have a valuer. So when I'm buying a business, I'm not allocating any individual values because that's the very basic construct of a business purchase, that I'm not going to value each individual asset and give a value. I'm just paying you for the whole thing, lock, stock, and barrel. So invariably, you will get a valuer to now, as an acquirer, you have to appoint a valuer saying, okay, I've bought this whole bag of goodies. Can you now please help me allocate some value? Because at the end of the day, I need a balance sheet where I can identify the value of these assets. So
Correct.
a valuer will typically do a purchase price allocation. Where on tangible assets, it's a lot easier. You find replacement cost, you find various other, you balance useful life and apply certain parameters and you arrive at the value. But there's always a premium that you've paid in your business. Now, is that premium associated to an intangible which is within the business, which means it could very well have been a self-generated software, for example, which they may have amortized during the business as a seller. But for the buyer, it's like a product which is going to be a revenue-generating product. It's a licensable product. It could be a brand. It could be a commercial right. The right to actually provide services, or right to provide certain, or right to earn certain income streams in perpetuity or for a longer period of time. So then allocating, so making that list of what all have you actually bought, because typically when we look at contracts, they say it includes anything and everything, but there's no deeper listing of what have you actually bought. So spending that time to understand what have you actually bought and what all is embedded within the business becomes important from a purchase price allocation. And to the extent you allocate value to such commercial rights and intangible assets, that's depreciable. The piece that is left is goodwill. Goodwill is an intangible asset for accounting purposes, but for tax purposes, goodwill is nothing but a premium that you paid because there is a value associated with the business. And in a very classical English level dictionary, if you look up goodwill is customer attraction, right? Your customers are stuck with you, or your vendors, and your business has a certain stickiness. That's really, as a very, very layman way, that's how I would look at goodwill. And so whatever you can't allocate to assets, when you do the purchase price allocation, any surplus that you pay is really a goodwill, and that goodwill is non-depreciable. So there is I think it's now become a very, very intuitive game of trying to figure out how the purchase price allocation does. And a valuer always struggles because the valuer is saying, okay, tell me what else, because he's not the guy who's gone and done the business diligence to know what you bought, what are the strategies, what are the rights, licenses, permits that you acquired. So that becomes very, very crucial in this.
Understood.
And so this PPA, purchase price allocation of intangible versus, was always the case that goodwill was not depreciable. There was an era of 7-8 years because of Supreme Court judgment, Smith's judgment, where goodwill was allowed to be depreciable. Every year budget, there was an anticipation that it will get terminated. It got terminated finally, but there was just a brief period. But otherwise, this stance of see how much intangibles can be loaded is always there.
Correct.
Right. Thank you, Ajit and Pratik. My next audience question is, I think, Nick, you're best placed to answer this. One of our audience members is asking, when you're talking of non-residents undertaking acquisitions in India as buyers, are they at a distinct disadvantage when one has to structure earnouts and deferred considerations from a pricing perspective?
Yeah, so I mean, yes, the short answer is yes. The rules do hamstring to some extent foreign buyers, because as far as, well, starting with the basic principles, a foreign buyer can, any earn-out is going to have to be limited to 18 months and from the agreement at 25%. But there are workarounds to achieve that, to get to similar. So, for example, and there's a range of possibilities. You could have a holdback structure where you buy all but a small stub of equity, and then the earn-out is priced based on the stub of the equity, where effectively the buyer would then pay the value. Now, the valuation, it still has to be FMV, but the choice of value may help at the margins. You can also have valuation assumptions that are built in. Again, the valuer has to, which may help the buyer. Ultimately, the valuer needs to be satisfied that those are objective and that those work. But that's another way that helps. There are other ways to structure earnouts as well.
Right.
Like, other forms of instrument to the buyer, which is then, sold back, or management fees. Those, of course, have implications for the seller in terms of not being capital gains but income tax. But these are the different ways, so you can achieve it. And more generally, in terms of the fact that if you're a foreign party, you can't buy at a discount or you can't sell for an overvalue. That is what it is. But like I say, by appointing the valuer, by setting valuation metrics, which may or may not work, or in certain cases, and this won't work everywhere, you can appoint a local party rather than saying, I will, if you have a call option, for instance, you might say that I don't buy the shares myself. I will nominate somebody local who will buy it on my behalf, and things like that. So arrangements like that and, creative lawyering, I think, can take you a considerable way. The only last thing I'll mention, and there's too much to say on this, is that obviously in certain cases, there is a line of case law following one case which allowed for a put option at a certain price, where in a downside protection scenario, and that was quite specific. There were warranties about its affordability, genuinely needed to be a downside scenario, and the way the contract was drafted was not quite a put option. It was that procurement obligation on the counterparty, which if it failed to satisfy, there was an indemnity. So those sort of more evolved structures can be considered, but just a word of caution, that was a specific set of circumstances. So there's only so far that analogy can go.
Understood. I'm afraid we are woefully out of time. We have several questions that have come in. So to our audience, I would just like to reiterate that due to time constraints, we won't be able to take up all your questions, but we will respond to each of them offline. Prasenjit, can I just request you now for a very quick concluding thoughts on, the various, we've discussed a lot of things, but just from your perspective, 2 or 3 main concluding thoughts basis the insightful discussion we've had so far.
Sure, Survi. I think firstly, some incredibly useful points have been made by all my esteemed panelists. I think if I have to club them in 3 buckets, I think the first one is the objective. I think when you at the very outset think of a transaction, you must sit down with all the relevant stakeholders in your company and then really chalk out the plan. Why are we doing this, and how do we implement it, and then how does it kind of fit into the larger scheme of things, and that's very important. Once that is done, then you try and structure that through an appropriate mechanism, again involving the right set of advisors, bankers, lawyers, tax advisors, etc. And whether it's a share sale, asset sale, business transfer, demerger, there are multiple factors, as we have noted throughout this discussion. There's no one size fit all. So if a demerger is great, we do have the time. If there are many liabilities, is an asset still good? Or a slum still good? Or is a share sale more simplistic, because you just have to drop a share transfer deed, do a SPA, fulfill whatever CPs are there, get it done with. So many factors actually are there to really come to a conclusion. So neither my friend Ajit will have the final word, nor the lawyer will have the final word. It's a holistic discussion. All advisors will have to really come to brainstorm and then kind of decide what structure works best. Last is, deciding the structure is one part. You still have to do the documentation, which has to be watertight, airtight, appropriate warranties, indemnities. You have to move along with times, as Rakesh mentioned, have W&I insurance package, which is increasingly gaining traction even in India. Have holdbacks, think creatively, and don't miss out on diligence, because unless you do diligence, you really have no legs to stand on to ask the seller for a holdback. It's only when you identify issues, then only you can tell the seller, look, there are issues in the company. We have to structure this transaction in this manner. I want to only do cherry picking asset sale, not a slump sale, because there are inherent liabilities I may inherit. So it's very important to keep these three aspects in mind when you structure and implement a business sale transaction.
Absolutely. Thank you. Thank you so much, Prasenjit. I'm afraid we've run out of time. Thank you so much, Prasenjit, Nikhil, Ajit, Rakesh, and Prateek for taking the time out. I know you all are incredibly busy, and several of you are taking these calls from various other locations, excusing yourself, taking the time out. Thank you so much. We're very, very grateful. To our audience, thank you so much. Mitesh, if you can just have the poll slide. Please, to our audience, please take some time out and give us your feedback on the poll slide. Your feedback is extremely important to us. It's the only reason why we've been able to run this M&A Master Series and several other webinars very, very successfully. Your feedback is exceedingly important. We take it very seriously. Once again, thank you so much to our panelists, and thank you so much to the audience for being with us. We hope that you will continue to join us in the next M&A webinar series that we have. Till then, keep watching this space and have a good day. Thank you so much. Bye-bye.
Thank you very much.
Thanks.
Bye.
Thank you, everyone.
Bye.